Hello dear students, today in this video we are going to study common size statement. Common size statement is a very effective tool for financial statement analysis. The major financial statements that can be analyzed using common size statement is your balance sheet and profit and loss account, also called as the income and expenditure statement. Common size statement basically a statement that is prepared to understand the ratio of each component of assets and liabilities to the total balance sheet. What is done is, here we try and understand that how much does each component of your balance sheet or profit and loss account contributes towards the total of the statement. What is done is, each component is reduced to the base of 100%. Simply I'll tell you, say for example we are talking about a balance sheet. The total of assets and liabilities side is the same, that we all know. This total is considered as 100%. And if the total liabilities is 100%, how much is equity capital in percentage as that of total liabilities? So there would be a ratio. The ratio would be calculated as equity capital upon total liabilities multiplied by 100. If it is on asset sides, it would be fixed assets upon total assets multiplied by 100. Whatever percentage value we will get, that will be put into the statement. Now why this is useful? See, it becomes simple to understand with the help of common size statement. When you choose common size statement, it makes it simple to understand the proportion of each component in the financial statement. What proportion are debtors in my balance sheet? What is the proportion of illiquid assets lying with my organization? That you can easily get with a single look at the common size statement. Yes, it also helps in understanding the trend analysis. You can easily do the trend analysis by using the common size statement. What is trend analysis? It is nothing but the year-on-year comparison of the same organization. Looking at the same figure for consecutive 4 or 5 years, one can analyze that how the figures have moved and how the organization has grown. Yes, that can be understood from this. It makes comparison of the organizations, that means between the organizations, within the organizations, the comparison of the organization with its competitor, and also the year-on-year comparison. Yes, it can be made for balance sheet as well as profit and loss account. You can frame the same statement for balance sheet as well as for profit and loss account. The only difference, the only difference between balance sheet's common size statement and P&L common size statement is going to be, when we are doing it for balance sheet, 100% is your total liabilities or total assets. Whereas when we are doing it for profit and loss account, your 100% would be considered as net sales. Your net sales figure is considered as 100%, and accordingly the other percentages are calculated. Let us go to a simple problem and then you will understand how exactly it is done. See, the problem is, the following is the balance sheet of ABC Limited for the year 2018 and 2019. Okay, this is the balance sheet. Liabilities side, 31st March 2018, 31st March 2019. You are ending on 31st March for 18 as well as 19, and on this side you have your assets. Now see, these figures are different. For equity capital, it's 1 lakh, 1,65,000. Preference capital 50,000, 75,000. Reserves 10,000, 15,000. P&L account balance 7,500, so on and so forth. There are many figures. The total of liabilities for 2018 and the total for assets for 2018 is same. That is by default has to be And for 2019, the total is 3,40,000, 3,40,000 for the assets and liabilities. Now, when such a balance sheet is given to us, what we have to do is we'll make the common size statement. We'll bifurcate. First, we'll look at the liabilities, and then we'll go towards the assets. Look at the now. This is the common size statement for liabilities of both the years. Look at this figure. Now, first we'll look at only this part, only for 2018. The right side part will go later on. These figures are the same figures available in the balance sheet that we have already seen. Now what is done? This total liabilities figure of 2,30,000 is considered as 100%. If 2,30,000 is 100%, how much would be 1 lakh rupees? That has to be calculated. And how is that done? It is simply 1 lakh rupees upon 2,30,000 rupees multiplied by 100. 1 lakh upon 2,30,000 multiplied by 100. What we get is 43.48. 43.48%. Similarly, 50,000 upon 2,30,000 multiplied by 100 will get 21.74%. For reserves, 10,000 upon 2,30,000 multiplied by 100, we get 4.35%. Creditors, say 20,000 upon 2,30,000 multiplied by 100, we get 8.69%. So on and so forth. So all these figures are nothing but a percentage of the total liabilities. A cross check is, if you add up all these figures on the common size side, the total should come to 100%. That's it. So this is the common size statement for liabilities side of the balance sheet only for the year ending 31st March 2018. And these are the percentage figures that you have got. Now the same calculation is done for the year ending 31st March 2019. We are talking only about the liabilities side now, as of now. Yes, so the total over here is 3,40,000. Now 3,40,000 would be considered as 100%. So what we will do is, say now we have to find out the ratio of or the proportion of equity capital. So what we'll do is 1,65,000 upon 3,40,000 multiplied by 100. It comes to 48.53%. Preference capital 75,000 upon 3,40,000 multiplied by 100. So we get 22.06%. P&L account balance 10,000 upon 3,40,000 multiplied by 100. We get 2.94%. Similarly, in the same fashion, we have calculated all these percentages. Yes, all these percentages are calculated, and if you add them all together, they will make up 100%. Yes. Now, why is this important? Here itself, you can see that suppose if we were not looking at the percentage figures, here your equity capital was 1 lakh rupees, and here it was 1,65,000. Now, if you just compare these two figures, 1 lakh and 1,65,000, how much is the rise? From 1 lakh to 1,65,000, you would have said there is a 65% rise in the equity capital, which is true as well. But when you look at the whole picture from the total liabilities point of view, from the total balance sheet point of view, what you understand is that this, even though it seems to be 65% rise in equity capital, but actually it is just 48.53% rise, which previously was 43.48. That means the net rise is around 5%. 48 minus 43, that's around 5% rise is only there. Yes, it is because we are looking at the whole picture. We are looking at the big picture over here. Preference capital, it was 50,000, now it is 75,000. So one would say that there is a 50% rise from 50 to 75, that is 25,000. It has gone up, which is true. But when you look at it in comparison with the total liabilities, what we see is it is almost the same. It was 21.74 and it is now 22.06. So hardly there is 0.3% rise in the preference capital. So common size statements help you in getting the true picture of the scenario of the financial scenario of the organization. Since now this was the liability side, we also can do this for the assets side. What is done? Assets, now fixed assets 1,20,000 out of 2,30,000. If you do 1,20,000 upon 2,30,000 multiplied by 100, you'll get 52.17%. Yes, and the same thing now. So same thing would be followed for all the components of assets side for 2018 as well as for 2019. Yes, debtors 50,000 upon 2,30,000 would make 21.74%. Prepaid expenses 5,000 of 2,30,000 makes up 2.18%. Cash at bank 8.69, cash in hand 2.18%. So all these are nothing but the percentages of the components of your asset side to the total assets. Same thing is applied for the year 2019. Yes, see, just look at this. Why the statement is important. Fixed assets were 1,20,000. In the next year, the fixed assets have gone up to 1,75,000. So there is almost a 55,000 rupees rise. 55,000 rupees rise in the fixed assets. But if you look at the whole picture, what has happened is previously it was 52.17% of the total assets. Now it is only 51.47%. So percentage wise, if you look at the proportion of fixed assets has reduced. If you look at the stock, it was 8.69%, even though it was only 20,000. Whereas, even though the value has increased, but the stock, that is the inventory, it has fallen down. Debtors, it was 50,000, that was 21.74. So from 50,000, even though the debtors have gone up to 62,500, but percentage wise, it was 21.74. Now it has come to 18.38%. That's the use. So what are you getting is you are actually getting the proportionate analysis of each component of your financial statement to the total of your financial statement. Yes, that's the beauty of the statement. And when an examination you have to solve, you just have to do this part. Yes, like we have done it in the previous picture, you must have seen for total liabilities, we have calculated the percentages, and in this, for total assets, we have to calculate the percentages. Again, I'll tell you the method. It is nothing but, say for example, if it is cash at bank, 20,000, what you have to do is to get this common size figure, 20,000 upon 2,30,000. So divide 20,000 by 2,30,000 and multiply it by 100. You will get 8.69%. That's it. You just have to calculate all the figures in this way just to tally them. If you add them all, they should make up 100%. The same thing would be done for another year, and that's it. This statement, what you have made, is called as your common size statement. Yes, this statement is called as your common size statement. By the way, your common size statement is sometimes also referred to as common measurement statement or component percentage or 100% statement as well. These are all different names meaning the same. That's called as, but most frequently used name is the common size statement. I hope you have understood this part. Similarly, we will also solve a numerical related to framing a common size statement for profit and loss account. Yes, I hope you have understood this problem. If not, review this video, try and understand it and solve it in your notebook on your own. Yes, this is a very simple problem and it can easily fetch you good marks in your examinations. Thank you.